S&P 500 since December 18th has been extremely volatile. I can't think of a better example on when you need the stool. The macro, fundamental, and technical landscape is changing almost daily. We can see obviously from when Itchy came out and how we responded there to when these rallies have absolutely failed. And while people are looking at protecting their downside, we are seeing these small rallies and they're kind of throwing everybody off when we're moving back. But I think that this really begs the question, what's going on underneath the hood? And we're going to get to that today, and we're going to show you how you can find it out for yourself in the future. We've been watching SMH or the stocks, anything in semiconductors, look like it's going to break, and we're seeing people try to protect themselves with puts. But what's happening is we're starting to see this curvature happen, and it's happening right into CES, which starts next week with NVDA. We have a ton to go over. Let's get to it. Hey everybody, 2025 is beginning, so we're going to jump right into it. I just want to thank everybody for subscribing to the channel, clicking all notifications. It does help greatly with the algorithm. I always find this fascinating. 27% do not subscribe to the channel, and out of those that do not even have all notifications on by 16.9%. These videos do come out at different times, so if you do subscribe, I strongly suggest that you click all notifications. They're pretty unedited despite what you've seen going forward with the first 20-30 seconds. So when they come out, they come out. So you want to click the all notifications. And I do plan on doing more impromptu stuff in the middle of the day this year. So you're probably going to want to subscribe if you find the content helpful. And remember, Saturday kicks it off and then we follow through with the week. So let's get into it. So we can obviously have this date from when Itchy started. And you can kind of see that this was pretty much what they are calling the worst Fed meeting in history. And it pretty much was. I mean, damage control was the next day or two where they started having like Mary Daly come out from the San Francisco Fed. They had her on Bloomberg. If you haven't seen that, what I would strongly suggest that you do if you're interested in the Fed, just go on YouTube, Bloomberg, and just go Mary Daly, Bloomberg, and look for this date. You'll find it. It's a really good speech, and it tells you exactly what's going on. What I find fascinating is that you came right to that date, and then you just held in here on the ES. So this is really that level that you want to pay attention to. You have these wicks, and until you break this wick down here, I don't think you have a lot to worry about. So I think that gets you on that 58.65 level. I know a lot of people like wicks. I do too. They are places of rejection and they are places of interest. When you get rejected in a place, you always want to watch that because it does become that place of interest. Do you have that support and resistance there, or how does that wind up playing out? And obviously you can see the slope and you have the mother of all H's. So we don't want to break, and I'll show you why. Whenever you have these, you take the top, and it looks like it's right there of these, and then you just measure down and you get a percentage move. What you do is you go to the low and you'll measure it off. You're getting 4%. So if we crack here and are unable to rally back over, you're looking at a pretty precipitous drop to the market, and that's something that I would pay attention to. I measure these moves. It does work. It's like back envelope way to do it, but it is fairly good. The other thing you could always do is just use fibs, take from here down, and then what you'll do is you'll get a fib extension that will tell you from that level on where you could get to. So you inverse your fibs and it'll give you a downward target on where the Fibonacci retracement is. Now, what's interesting about that is that when you come here and you measure that off to that level, you'll get 4%. When you come from that and you come down, it's actually a little more conservative than usually these humps that are telling you. So just interesting if you're trying to get a more conservative way of looking at it. That's one way to do it. They're just guides. They're not hard, fast rules. Now, what we did see is exactly what you wanted. You did bounce off that Thursday and you did hold. Now, a lot of people really didn't expect that to happen, myself included, with the way that we sold down, but it did. And so now we're starting to rally, and the question becomes, is this going to continue? The breadth got better for sure, and we're going to go through that, but let's just throw RSI up for a second and see what's going on. And I do like RSI here because it does tell you a story. Whether or not you want to use it doesn't really matter to me one way or another, but I do like looking at it. Now we're just going to mark that off right there. And you can see how we're making these lower lows, and then what's happening? We're making these kind of higher lows, right? So we have what we would refer to as a divergence, and you have another one here where you're actually over already here. And I like that a lot, where all of a sudden, yeah, you're overbought. Maybe you shouldn't be there yet, but when this starts moving, it tells us the magnitude of the move, and that's what we want to see. So we have this trajectory that's going on. We can all see this DTL, or downward trend line. We're not going to spend a lot of time on it, but I just will pop it in for people so that they can see it. And you tried to break. So the first level that we need to break right here on the futures is right in there, and that would be that 59.92. People are just going to say 6,000. It depends on how you're trading, on how specific you want to be, but you can see the levels of Matumbo sitting right there. And as always, we want to watch where we are rejected at. Now, today's video, we're really going to focus on key levels that are dealing with technical. We're going to do some fundamental, but I really want to show people how they could look at the breadth of the market and start making some decisions for themselves, get a little sharper here. But I do want to point something out before we go any further. There are some massive things on the macro and fundamental side that you're going to have to look at this week, and you're going to have to pay attention to. So what I would suggest that you do, and this is just a side note, create a calendar, go to trading calendars, any of those sites like Trading Economics, anything like that. But create a trading calendar on some of the macro data that's supposed to come out this week. I don't want to get into it because I really want to focus on the breadth in this and what's going on under the hood. And as this develops, you'll see why. But if we look right here, we've already hit this level on November, 19th on Tuesday. And you can see it right here as well on the 5th. And we just kind of popped over, came back down, retested, came down, retested. Say it with me. Retested. So when we see these, we want to pay attention. We don't want to break this level. And if we want to get super specific, we certainly don't want to break this level. We'll put the magnet right there so it drops perfectly. You certainly don't want to break 58.55. We definitely want to watch that level. And you can see these resistance points up here as well and how we held, and that's 61.0750. So these are pretty standard levels that you'd want to pay attention to. You have this one over here, but you already ran buckshot on it, didn't you? You just kind of ran right through it. But on the way up, we know that support is what? Resistance. So if we do break above this 6,000, then we know that this 60.53 level is probably a level to contend with, and we'll go from there. What's going to get us out of that? Some of this macro data might, and also you have things like CES that are this week that we will get into as well. There's some other developments that I think are really important about some Latin America movements that we haven't seen in over 100 years, and I do want to cover that, but we're going to cover that more towards the end, so just stay with me. Now, in front of us is the breadth by looking at the 200-day, the 50, the 20, and the 5. And what we're looking at here is the 5, the 20, the 50, and the 200. And this is percentages of stocks that are above their moving averages in regards on the S&P. You can also do this on the NASDAQ, but we're going to do this on the S&P. Right? And what we're saying very clearly is we bottomed out, rallied, and hardly moved, and then came back down. And now we're trying to rally again. Now, the difference that I see now, and what I think is very important, and I always get asked this, do I get into this kind of detail? And the answer is yes, I do. Because I think that the devil's in the details. It just is. So if we take a look at this, we can say, okay, well, this is December 18th when we got completely washed out by Itchy right here. And then we rallied up, and we had this explosive rally. And then when we had this explosive rally up where all these stocks went back over their 5-day moving average, these hardly moved. They hardly moved. Now what's happening is this is broadening out and taking its time. You don't want these vicious moves. These vicious snapbacks are reminiscent of any kind of bear market rally. You don't want that. And I don't care if you call it a bear market rally. We're not in one, but I got that. But what I'm saying is that's a sign of just straight up short covering. Even Friday had some signs of straight up short covering, and we'll get to that. But what you're seeing here is you're seeing this start to develop. And when we're watching the 5 develop, we have to understand that as the 5 develops, you want to watch the 20. As the 20 develops, then you want to watch the 50. As the 50, the 200, you get it. So what we didn't have here was any kind of development on the 20 or the 50 or the 200. You didn't have that. You just popped, and then some of these things kind of popped with it. Now this is developing. It's a little bit different. So when we drill into these, we're starting to see a little bit of a difference here. So we do the undercut, which I kind of care about, but not really. But now you're starting to develop. And again, this is FI, so this is the 50. But you're starting to develop a little bit more here where we're not having these extreme moves. We don't want that. We want the development. We want it to build. If you go look over time, when you look at the 50, you really don't want to play with this unless you're above, meaning long or swing trades, unless you're really above here. The real money and where your swing trades get super easy is when you're above this 50 line. If you go and look at your equity curve, you'll realize it fell apart right around here, right? About 2 days or 3 days before Itchy spoke. That's what you want to pay attention to if you're looking for more of a longer term kind of situation, if you're trying to figure out why your swing trades aren't working the same way. What we want to make sure of is we want to make sure that we're not just seeing some kind of short covering rally, and there are signs of that, and we'll talk about it. But what we really want to see is we want to see this develop. And before we can say we're out of the woods, you'd have to go and look at what out of the woods looked like on the 50. When you finally flipped it here in October or November, rather, 2023, look at how you acted. It was just straight up, right? You didn't have any problems. You had these little dips, and then you kind of played around with it a little bit. This is the lowest reading that you've had since September, October of 23. And if you go back looking at these times, it was not the best of times for traders when you're under these levels. The trough valuation is around the 8, 9, something like that. And if you go back far enough, you can really see that there were times when you actually had like 2 or 3% of names were down here. And then of course, when you get up to 90% is when you need to kind of concern yourself, but you can stay up there for a while and the breath can just get worse and worse. So I don't really look at it as a be all end all here. I'm more interested when I'm down here because it can only get so bad. You can only have so many names under. But if that's one way to use it longer term, but how to use this right now is, okay, is this going to develop? And the answer is it is, but you want to watch the 20 first. And if we watch the 20, we can actually see the higher high. Now, why is this important? And I can show you why it's important in a moment here, but you see how you're over, and when the 5, we just looked at the 5 and how the 5 was at a 95% here, and all of a sudden now you're over. And so what this means is even with the 5-day, let's look at that. Even with the 5-day not back at the same level, with that extreme move, we're watching the 20-day actually get over. And what this is telling you is that, again, we need the 5 to turn, but then you need the 20 before you can the 50, the 200, you get it. Why this is important, if we're gonna make a higher high and the 5's not at a higher high, we have a lot more to go before you're short-term overbought. And the breath is getting better and better, and we're gonna talk about that in a second here. But this is really important to get, because when you see this little nuance, it's a big deal. It's a bigger deal than people think it is. So I would watch this very, very closely. Now, the easiest way to get a copy of this so that you could see it, and I'm going to make this a weekly, is you take the percentage of names that are the 20-day and you divide them by the percentage of names that are the 5-day. And what you're going to do is you're going to get these outliers where you're going to have extreme moves for sure. But if you take out the outliers for a second, and they are telling you something, but what you're really focused on is when you get to these extreme levels, what happens? And we just had one. We literally just had one. And I think that's kind of interesting that it's happening now. And let's just highlight these really quickly so that you can see where you're at. And then if you look at other times when this has happened in this area, you can see like right in here that, yeah, it did kind of determine a bottom, didn't it? And so we want to pay attention to that. I really don't like, and below is the S&P, I really don't like using the COVID data because it's so skewed for so many reasons. But if you go through these levels, this has only happened a couple times. And so when we overlay this with something as simplistic as looking at breadth, and then we start looking at, okay, well, what's smart money, dumb money doing? What are institutions doing? It tells us a story. It's just up to us whether or not we want to listen to it. Now, one of the most important things to track right now is what are institutions doing, more so than to worry about what retail's doing. We already know that retail's all over the place. They're pretty skittish right now. But watching institutional sponsorship, either there or not there, is one of the most critical things that you can do in the beginning of any year. In front of us is Smart Money, Dumb Money, and it is by Sediment Trader. This is not done by me, but I want to point that out. I have no affiliation with them. Now, for those that are new, we don't call this smart and we don't call this dumb. We know that the way that this is calculated is very simple. It is calculated by using institutions and retail, so ETF money and then large lots on the futures market. I'm just giving examples. That's not all it is, but think institutions, think retail. When you think like that and you understand that little nuance, it's really important to get this, because then you can figure out what are institutions doing and what is retail doing. Now, you don't always want to buy or sell when one is doing the other, but one of the things I brought up about 2 weeks ago was that we had this little situation going where we were dropping down here on retail and institutions looked like they were starting to buy. And the one thing that you never really want this, but you don't really want a situation where this is dropping faster than this is buying, because then there's no movement. And you can kind of see what you start to get when this happened. But when you start breaking out here and this starts slowing down, well, it just makes sense that if institutions and retail are both buying, you're probably going higher. So if you're maxed out on something like institutional buying and then retail decides to start buying, well, you're probably going higher, and that's probably going to put it in a bottom. So hopefully you can see why this is important again. In other words, if you can see that institutions kind of maxed out and took in a lot of the supply, and then retail decides that they want to start buying, you can see why that might form a bottom. So we're not anywhere near something where they're maxed out, right? We know that institutions are not maxed out, but we do know a couple things. This cross is definitely something that we have to pay attention to. We know for a fact that this cross is a big deal. And we talked about this 2 weeks ago. I'm not going to hash into all of it, but I will tell you this: when this crosses, it starts the formation of a bottom. And why is that? Well, it makes a little bit of sense if you think about it. If institutional buying is crossing that of retail selling, well, then you're hitting an inflection point. And if you look at all these inflection points, they all have one thing really in common. And we're going to go back throughout the past 20 years, just look at a couple examples of this so you could see it. Because you always want to go back as far as your data can go back, just to look, just to see what happened. And it's really kind of interesting. It doesn't predict the bottom. It predicts the beginning of a bottom. So again, if you just took that mark right here, you could say, well, that wasn't a bottom, and that certainly was a bottom. And we crossed here, and that certainly wasn't a bottom. But it tells you, like, okay, you might have another, by looking at it, what I've come up with is it's roughly about 2 weeks of just nonsense from when that's happened, and then that forms a bottom. That's what it seems to be. But when we're eating up that supply, which is exactly what you're marking here, it's supply and demand, you're starting to see this. Here, let's look at a couple other examples. And one of the things we really try and do on this channel more than anywhere else that I've noticed is how you can look at this data yourself and how you can learn to interpret data. I don't think a lot of places do that, maybe because they don't know how to do it. I'm not sure. But you want to learn how to interpret data for yourself, because you might see something and completely disagree with me and see it a different way. And of course, not all of them are going to work. So if you go and take a look here, you could say, well, that didn't really work. Well, yep, I agree, because you had retail that was just absolutely puking. And if you're studying this stuff, you would go, yeah, well, retail was puking. And it didn't really work until we maxed out here. And then after we maxed out and then retail stopped puking, well, that's when we put the biggest bottom in the market ever, right? And you can actually even see the divergence here if you take a look at it. Now, I don't really buy into divergences that much with this, but I just thought it was interesting. So again, if we mark these levels off, and you're looking at it and going, oh, well, why did this one work so well? Well, retail did what? Retail didn't puke like they did here. Therefore, we didn't have the drop that we had. See, when you know what this stuff actually is, and you don't refer to it as like these little pithy names, but you refer to it as retail and institutions, you can actually do more with the data when you understand what it is. Even here, you could say, well, why did this cross work? They're not really crosses that you identify. Well, we all know this is when Itchy said, we're going to stop cutting, or we're going to stop raising rates. And we all know that institutions really puked a lot of stuff out already, and retail got super giddy and started to buy. So there are ways to look at this data and interpret it, but what I'm doing today is giving you just simply one way, because it fits perfectly with the situation that we're in right now and trying to figure out what's going to happen. There's a lot of different ways we can look at data, and the important thing is to use that data at the right time. And what I mean by that is everyone has tools in a toolbox. Sometimes you need a hammer, sometimes you need a screwdriver. And so you have to look at where you are now and kind of go from there. Again, Sentiment Trader, no affiliation with them. I just took a snapshot of 2016 to 18, and you can see some similar behavior here, and I thought that this was just kind of important to note, because again, what we're looking for is we're just looking for pattern recognition, and you can see right here, if you just came all the way up, here you are, and then you have about 2 to 3 weeks of just nonsense where you're just kind of banging around, maybe about a month in that situation. And you can see this over and over again. Here's another one right there, and if we just came straight up, you can see that we sold down for a little bit and then reversed. And then again, of course, here on the 18, where they decided that we're no longer going to give us free money, and he decided that he was going to start trying to raise rates. How'd that go? Not very well. And then you can kind of see we fell down for about 2 weeks, and then all of a sudden everybody adjusted, and then we moved forward. Now, some of these are going to be glaringly obvious, and as someone wanted to show me that they're thinking about making a cologne for me because I say that too much, which I thought was humorous. But there are examples of here where it is absolutely glaringly obvious. And I think it's important to put out examples not only where this works, but also areas where it doesn't work. So you could obviously see that here we're about that 2 to 4 week out, and I'm using January 2007 because I want to go back in time so that you can kind of get a sense of this and see how this plays out. And again, not every single one of these is going to work. So it's not like a automatic thing. You're just like, oh, let's just do it. You use this as a data point. And the most important thing about this is what else is going on. In other words, if retail is just puking their guts out at the same time, it's probably not going to work as easily, right? And so that should obviously be glaringly obvious to everybody. I'll use it again. Here's the inverse telling you that you're probably getting some kind of peak because retail's getting in. Now remember, if retail's getting in and institutions are getting out, you got to have to think about that a little bit because retail cannot hold the weight up. I keep thinking about Sisyphus pushing a rock up. Think of that. And here's a great example. They get fully pot committed And then what starts to happen? Retail pukes. But this is also an example of this not working. And that's really important for you guys to get. It's not like, oh, the guy on the internet said that when these two lines cross, we're definitely going to go up. No, it's not what I'm saying. I'm saying it becomes a place of interest. The real question becomes, are they going to continue or are they not going to continue? Are we going to see retail start to come back in? Now, I saw some signs of that. I'm going to show you guys how to read data, advanced decline and stuff in a little bit here. And I'm going to show you from a free site, so stay with me. But we want to look at this. And yes, I'm going to just keep hammering these points home because they're really important points. Again, here you are in 04, and you can see that, yep, that did determine a bottom. It didn't say that it's not going to fix all our problems, okay? Nothing is going to fix all our problems. But what it's going to do is it's going to give you an inflection point where you as a trader can understand what's going on, right? And then say, okay, this is something we need to pay attention to. So just bear with me. Voice is a little scratchy this morning. I'm recording this Saturday morning, but you can see these levels right here. And I don't know why. We don't really get allergies here. I'm in Miami. We don't really get allergies. That one's a disaster, isn't it? But what you're looking for is over time, over about a course of 2 to 4 weeks, we'll start to see this. Now, there are other indicators, as this is longer term, that you can use. But for our purposes and the purposes of this conversation, what we're really focused on is one thing. We are at an inflection point, and that's what I want you to take from this. Now, how would we determine if this is going to be a better inflection point or a worse inflection point based upon the data we just went through for the past 20 years? Is if this level on retail starts getting better. And we can determine that, and there's ways to determine that. But there's also ways to determine, is smart money getting stronger? Because if institutions are getting stronger, then they can eat up what retail is doing. But we all know that retail doesn't like to miss out, and they just can't wait to get involved. So this is going to be really important for us to note. Smart Money Index. What is it and why do you care? Very quickly, Smart Money Index. What you're looking at here is a calculation. It was done by a gentleman named Don Hayes. It started in the 50s, late 50s, early 60s. And why do you care about this? All right, so what they do is they understand that retail moves in the first hour, and institutions tend to move in the last hour or last half hour. So what they do is they take institutions and retail and they compare them. So, for example, let's just leave that line in for a second because this visual will help you greatly. And I think it will help you greatly. So, if you're in a situation where retail is buying the beginning of the day, if they're buying, it gets a -1. If they are selling, it gets a +1. Okay? So in other words, whatever retail's doing, this does the opposite. So it will deduct or add, right? But it does inversely. So hopefully that makes sense. So retail's buying, -1. Retail's selling, +1. So Don Hayes does not really think very highly of retail. And what's interesting is it actually works out fairly well on some of these turns. And you can see the big turn, obviously, right here. And then what it does with institutions is it does the exact opposite. So institutions are buying. I'm going to show you in a minute here when you should be looking at institutions and how you can see institutional flow. Pretty interesting, and I can show you how to do it for free. And you can do it every single day. And then what you're doing here is, are institutions buying or institutions selling? Institutions selling at the end of the day, then you get a -1. Institutions buying, okay? So buyers, and this is what happens in this quadrant for retail and institutions. Sellers, this is what happens. And then, of course, you can see how you can get all these different variations of what would happen. We have selling from retail and we have buying of institutions, right? We have buying of retail and we have selling of institutions, et cetera, et cetera. Now you know how this is calculated. There was probably an easier way to do that, but you just powered through it. So let's just keep moving on. So what we're seeing here, in my opinion, this is 5 years of it. Look at this. This is not great. Now, why I'm pointing it out is because you're still going up. And that's not really where you want to be. And what this tends to do is it does mark off these levels where when you peak, you peak. And yeah, maybe you'll pick up later and then you'll find another peak, but you want to look for the valleys. The valleys are where it gets interesting. And why? Because that means they're at trough where they're no longer buying. And you can see that, right? If you get to a point where you have max retail and max institutions not doing something, that's what you want to focus on. Just the same thing here, we had the exact opposite, right? When you find these spots, you want to pay attention to it. I think you're developing one. Now, if we look at the Smart Money Index and we look at this peak, if you go to this peak or this peak as it dropped off and you keep going higher, it's very clear that your equity curve dropped off right around here. Right around December 12th is what this date actually is. And from there, this is why you're having issues. But look at this level right here. You're starting to turn again. So are we at an inflection point where we're starting to see some buying? And if we look at 2025 very quickly, this is retail off the open, puking their guts out. And then you can just see how that played out. And again, they came back in, but then what they do again, they got a piece of data and they puke their guts out. And then you get into an area, let's just take the last hour, which is really what you should be looking at, really the last half hour. I'm going to show you how they're packing this data in a second here. But look what's going on here. Oh, they're buying for the last hour. Okay, so what's happening here? Retail's kind of puking, but then they're back down. And then you're back to this level. They do the undercut, the flim-flam, right? And they just steal from everybody and then they rip it. But where did they really go in the first hour? Well, retail really didn't go anywhere. And then you would go, okay, well, where did institutions go? Well, they actually, if you take that last hour from here, they actually traded up. And it is a numeric system. So in other words, the way that Smart Money Index is calculated is numerically. So they do take from where the SPX was, and they do it by, points. I just did +1, -1, so you could get a sense of it. So what does this really mean to us when we look at it? Well, what it means to us is that we are, since 2025, we are seeing institutional buying. And I'll show you this when we really drill into the numbers. You see, the thing about these numbers is once you start understanding how they're calculated, you can start pulling the data out on a daily basis and just look at it. And we'll get to that in a second here. Now, if you watch this lower low and then you watch this high, if we just kind of take a look at this going out a year just to move along with our lives, you can kind of see the undercut here. What we're going to watch here is to make sure that we don't undercut this. Because if you undercut this, then that's going to continue this trend down, and that's going to mean institutions are going to sell, which is not what I think is going to happen, especially after what we saw happen on Friday. And we will get to that, and I will show you some other things that I am a little cautious about and a little concerned about. But for now, what we need to focus on is, yes, this may have bottomed. Now, the fun part. The data that you have in front of you is from the Wall Street Journal. You can literally type in Wall Street Journal, advanced decline line, and get this yourself and look it up. Here is the date, so you can see exactly when we got this. Here is a week ago. Here is the previous close. Here is the latest close, and they call it diaries. And this is the New York Stock Exchange. And we're going to go through this so that you can understand when you see this data, what the heck are you supposed to do with it? And I'll show you what I think is pertinent, and then I'll show you a way that you should be smoothing out the data and then relating the data to a very specific period in time. I'll walk through that. But if you go here and you say, okay, New York Stock Exchange, this is the issues that traded today. This is our advances. This is our declines. What you tend to do with these numbers is you would just take these two and divide them, right? There's a different way to do this, but for all intents and purposes, the easy back envelope way to do this is just go, okay, if I take these two numbers and I divide them, I'm going to get a number, right? Out of that number, advances divided by declines, I'm going to get a number. Some people will take issues traded and then divide it by that to get the ratio of total issues traded and then what percentage are declines and what percentage are advances. All I'm going to tell you to do is the easiest way to come up with it is just take this and just, you can even, envelope it in your head where you just go, okay, this divided by this, I'm going to get a 3. Okay, so all right, 1, 2, 3. Great, 3 to 1. All right, so then you would just go 3 to 1 and just put that there, and then you make a little 1 there, and that's an awful drawing, but it is what it is, and I'm not going to have time to edit it. And I'm laughing because I'm thinking of the memes you guys sent me. So then you would go here and go, well, is 3 to 1 better or worse? Oh, okay, look, the previous day, what happened? Well, then here we were 1, 2, 1. Okay, so see how that worked? All right, great. And then where were we a week ago? Well, we were in the toilet, right? So we weren't 1 to 1 here. You were 500 to 2,300. We're going to call that. So then you look at that, you'd go, we were 1 to 5, right? So then you'd look at this and go, okay, well, that we were 1, 2, 3, 4, 5. Sorry, you had to live through that. So then what you're seeing is going, okay, from a week ago on the New York Stock Exchange, has the breath gotten better? Well, we were, only going up 1 for every 5 that were down. And then yesterday, what did we do since the market opened? We went 1 to 1, which is actually an inflection point. You might want to remember that. And then what did we do? We went 3 to 1. Oh, okay, so is the breadth of the market getting better? Yes, the market's getting better. You have empirical data in front of you telling you that it's getting better. And now you know how to do this for yourself. And you can do this, it's free. And you can just look at this and go, oh, okay. Then you can look at the new highs, the new lows, right? And then this isn't great. These new highs at 38, 58, 31, 45, 49. But is it the suck salad that you had a week ago? No, it's not, right? This was awful. but it's not good. I've seen good before. It doesn't look like that. All right, so let's clean off my masterpiece and continue. So then you'd look at the advanced decline, and I'll show you how you want to skew this in a moment here. But then you would look at the advanced decline lines on the New York Stock Exchange, and this we're just doing New York Stock Exchange, and then you'll be able to show like which exchange you actually want to focus on. And then you can see the advanced volume versus the decline volume. The easy way to do this is to just take these numbers and divide them, and you'll come up with something. There's a way to smooth them out and get a multiplier on how significant the move was. It's called the Z-score or a standard score. I'll show you very quickly how to do that. But what you're doing here is then you're looking at the previous close and going, did it get better or worse? Well, if you did the math, did it get better or worse? Well, if you just eyeball it, you can see that it got better, right? Because you're not going to do that again. You don't want to live through that drawing. That was awful. So then you would go here and say, okay, well, where were we a week ago? Well, there we are. So that fits the narrative on where we are. Now, this is what the New York Stock Exchange does, which is awesome. See these block trades? Well, we know that that's not Freddie Fingers doing block trades, right? So if Freddie Fingers isn't doing block trades, who is? Institutions. So this ties back into smart money and that equation we just went over, and smart money, dumb money. All right, so this would actually tell you where the money's going. And what's great about this data is they break it down by hour. They actually break it down a little bit even more. And so you could go here and go, okay, on the block trade side, you're at roughly 2.5 to 1, but there's a way to skew this and smooth out the data, and we'll get to that. It's a little advanced, but then you would just go here and go, okay, well, was this better or worse than the day before? It was better. Okay, where were we a week ago? We were here, and that was disgusting. Right? So are we as gross as we were a week ago? And the answer is no. So is the breadth of the market getting better on the New York Stock Exchange? The answer is yes. This data is free, guys. All you have to do is just go into the internets and type advanced decline, New York and Wall Street Journal. And this will all pop up for you. It's just called diaries, and it's all sitting right there. And what's important about this is not subjective. This is just the data. It just is. So if we took a look at the NASDAQ, for example, you go issues traded, you go advanced declines, and you would know that real quick, you could just go 3 to 1, and then you would just go here and go, how about yesterday? Well, we were at 1 to 1, and where were we a week ago? 1 to 3. I won't make you live through those drawings. So you would note that the breadth is getting better on the NASDAQ. This is objective data. This part of it is not open to interpretation. It's not open to interpretation that a week ago you had 94 new highs, 91 new lows, 85.58, 94, or 93.45. So what do you have here? You're at 2 to 1 on new highs versus lows yesterday. New highs versus new lows. We're gonna need more coffee. And then you have the block trades. Now this is where it gets super interesting to me. So if you take these numbers, right, you're gonna get 3 or 3.5 to 1. And then you would go here and go, oh, well, that's roughly where we were yesterday, yes. Then you would go back and go look at where you were on block trades 1 to 1, okay? So you have this data in front of you, and now you can see how you could use this data to make decisions. But just remember this data for a second. You could take the weekly totals, because they'll give them to you at the end of the week. And I would suggest that you do this. And it's a little complicated, but what you do is you take the advanced decline lines on the week, and you're going to get a skew. Take that skew, and then you would take that skew, whatever you wound up with. I think in this case it was like 1.83. And then you multiply that by whatever happened on Friday. So that would give you the skew on what happens at the end of the week. And that's really important. It's called the Z-score or standard score. They have their own like little Z volumes down here. I'm showing you how I do it. Why do you do that? Because if you're skewed on a Friday, which is really what you want to look at, and the reason you always want to look at Fridays is because of institutions and how they work. Now, I don't want to spend a lot of time on this, but if you're a pension fund and you have 1 million shares of Apple and you went to JP Morgan and said, sell 1 million shares of Apple, and they only sold 800,000, you're dumping on Friday. You have to get out, right? You have certain parameters that you have to follow and abide by in your charter. Nevertheless, so what you do is you take this, okay, and you're going to come up with a number. At this point, it was 1.83, and then you're going to multiply that by what happened on your other ratio, and it's going to skew your ratio one way or another. Now, why is this important? Because if the advanced decline volume on the week was, let's say, inversed here, then the data that happens on Friday is not as big as it looks like. For example, let's say that this 1.83, when this is calculated out, all of a sudden was like 0.5. So that's going to change the entire breadth of what happened on Friday. All right, so this is a better way to smooth that out and to see what's really going on under the hood. Other thing that the Wall Street Journal, this piece does a great job of, is it breaks it down by half hour. It literally will take the New York Stock Exchange and break it down so you can see the volume flow. And I think that this is really important because I don't think a lot of people get this. So if you look at this over the week and you say, well, where were we last, like the day before? Okay, so retail is doing less on Friday than they did the day before. A week ago, they hardly did anything, so they're starting to not get as giddy off that first half hour, right? But why is this important? Because if you look at this data, you can see how skewed it is. So then when you're having these moves that are in the middle of the day, and I'm going to go off on a little bit of a tangent here, you can see how you can get counter trend moves in the beginning of the day, right? So like here, so you see like how this volume is just kicking in. It's 2x the next half hour. So this is why people develop plans for like the first half hour of trading. And this is why certain trading kind of movement will work. And then by 10 o'clock, it's garbage. And then you always look at the chart at 10 o'clock. You'll note that sometimes you'll see these inflections when data comes out. Look what happens to the volume after the first half hour, okay? And then after that, look how it drops off. So if you look at like in between here, there's hardly anything going on. You can actually come down to 3 o'clock and what we refer to as the last hour. There's a chart that I study called the last hour that I watch very closely. But what's really interesting about this is you could see how you could get lulls. So like if you have a chart and that chart's doing exceptionally well and that chart's like going up and you're all excited and then all of a sudden you see this little dip and that dip happens at like 12:30 and you think your hopes and dreams are smashed. They're probably not. It's probably just lack of interest until the end of the day. And so you always want to keep that in mind. They always preside another opportunity for you to kind of get in. And I can give you an example of this. Actually, I will give you an example of this once we're done here. I'll give you a really good example so that you can see it. But what's important about this, let's clean up all my nonsense and go from there. I thought that button would do it. Does that do it? No, bracer. All right, there we go. Boomer trying to use the internet. So look at the end of the day. This is why you want to watch the last hour. And what they're doing is they're taking it down. You can actually break this down. They're actually almost packing it all into the last 10, 15 minutes. But you need to watch the last half hour. If you're not watching the last half hour and you're not watching, and look at how all this ties directly into what? All this ties directly into smart money, dumb money, the smart money index, and what's really going on under the hood. That's why if you had to say like what times of day should you watch the market and want to know what type of flow is going on, is it busy? Is it not busy? It's the first half hour and the last half hour of the day. In the middle, this is when you will see those changes, right? You have this whole block of time. But in the middle, that's when you're going to really want to pay attention to those changes that are going on with your trades, whether that's up or down, because it's just late volume. So if you're breaking out on late volume, it might just mean that you just don't have any sellers left and you see them at the end of the day, or vice versa. So you're really going to want to pay attention to this. Now, here's an example. Now, if you've been watching this channel, some of the names we've been talking about are CEG, VST, TLN, BE. We've been talking about these energy names, specifically energy on demand names, and CEG got a contract with the government and everyone's all giddy about it. Now, you can see the opening price here and you can see when the contract got announced. What's important about this? You get your first move, right, off that, okay? So that's not going to be tied in with the morning, but what happens in the middle of the day? And you should be able to see this pretty clearly, but let's just highlight it for everybody so that they get it. In the middle of the day, you just have this lull where you're just sitting. And then you look at the time and you go, okay, well, there's 3 o'clock. And then you're like, oh, okay, well, we're not seeing anything, but wait, what starts happening around 3:30, like right in here? All of a sudden, everybody starts getting involved. And that first half hour on, look at the move in the stock. So why people are blowing out of it here using all their knowledge and saying, oh, well, we undercut this little support right here, and therefore that's it, I'm going to get out of my trade. All these little dips are being bought, and people are trying to figure out why. Well, the reason they're being bought is because you really don't have any selling, because you know that the volume is pretty much dead in between this period in time. So all you have to do is just say, okay, well, how do we act in the last half hour? And then what's interesting about these kinds of trades, why we're on the topic, is all you have to do is just watch the open. And what are they doing off the open, right? All this stuff ties together. Well, they're dumping off the open. Well, if you overlay the same principles with like the smart money index, where retail dumping off the open is actually positive versus institutions at the end of the day, what happened here? Retail dumped, right? And then they got flim-flammed because they got scared. And then what happened at the end of the day in the last half hour? You didn't really have any more buying, did you? Right? So this would tell you that, okay, well, maybe this thing's played out a little bit, or maybe it's the op X on the trade. But what you do is you overlay these principles. And by overlaying these principles that you just learned through smart money, index, and things along those lines, what did you notice here if you took a look at like VST? Well, retail dumped. Okay, after retail dumped, what happened? Did institutions buy in the last hour? And the answer is yes, right? And all of a sudden, this stuff will become glaringly obvious, and it will help you decide which names you want to play with and which names you don't. I hope you found this helpful. As always, comment because it lets me know what I should be focused on. If you take a look at what we just went over and you utilize this, you will find that your life gets a lot easier in determining what's going on in the world. Friday in and of itself had some developments we need to go over. First, let's start with the elephant in the room, which is NVDA. And I think that this is really important for a couple reasons. There's some structure that developed here that a lot of people did not catch or see. And I'm surprised it actually worked this well on Friday, considering the options that were against it. I mean, you had so many people out there that were betting against this thing. And then when you look at it from just the simplest of standpoints, where you have like the 12, the 22, and the 55, and then you're watching how we break, the idea that this was going to continually outperform as it did on Thursday, which was a telltale sign, but the gap up. Now you have CES, which is a huge conference that is going to take place, and they're the keynote speaker, and this is Monday night. So this is why it's getting the love. But there's a couple developments here, and we're just going to drop this back and talk about the structure, because I think that's really where it's important. If you look at this close in this second, if you look at this close, that's a pretty substantive close. Like if I was to tell you that NVIDIA just had one of its top 10 closes, most people would be like, no, and there's no way. But yeah, here we are. I mean, you really just have this type of structure right up here, which was our problem before, where we kept running into these issues. But other than that, this is it. You're here, maybe that as well. But that's really important to get. The volume is very important to get, but you see the change in pattern, and you can just kind of get your sense of this right in here, right? Where you have this DTL that you broke. I get that. But more important than the DTL here, watch. More important than this DTL or downward trend line to me is the structure of the move. So in other words, we started to ride this, looked like we were going to break the original one, which was right here. This was the original DTL that you did break, and then you rode the line of it. You never really got below it, right? Now, why is that important? It looked to me like we were going to crack. And so once I break a 55, we were in here. Once I break a 55, that's it. I'm out. Especially when you're doing this kind of stuff where you're trying to get above it and you fail. Try to get above it and you fail. I'm not waiting. I'm not. Now, obviously, in this case, should you have waited? Maybe, right? Hindsight's a beautiful thing, isn't it? And if you live in hindsight, you're going to have a problem. What I really like about the structure is that now you have a higher high in here. So you're actually setting up this little inverse head and shoulders that's in here, and I'll just show you it. It's kind of interesting. And there's another way to look at this too. But if you look at that line, it just said left shoulder, head, right shoulder, you're flipping, and you're flipping into this. Now, does this continue, or is this kind of a short squeeze? That's where this whole move on Friday gets super interesting, and we need to discuss it. To me, this was typical short squeeze behavior. I don't know if it continued. And here's the bottom line. Nobody does. I would say the gap up is pretty impressive. Nobody really expected that. You have a couple people out there that said, oh, they knew this was coming. That's like predicting the greatest move the stocks had in the third quarter. I mean, you only had one or two other moves that are even remotely like what happened, right? You had this reversal here, and then it just faded. So I think it's really important to understand that, put this in context. But you did flip. You are moving higher, and I don't know what he's going to say at CES. Obviously, he's going to say good things. I mean, he's not going to talk poorly about his company. So you're probably going to see another follow through. What you'd want to see is start getting through these peak levels. So for us, we'd want to see it get through that level right there, which is the doji, which also ties and correlates perfectly with these levels where you got completely Matumbo'd before. Rest in peace, Matumbo. So you're looking at that 146.54. And then from there, you could come up and look at your next level, which again, I think is absolutely glaring, 149.77. How many times have you closed over 150? How about never? So I think that this is really important for us to get, and you can see back here as well. Look at this level from that wick, from that bar. It's kind of crazy how you couldn't get over that little level right here. So, and it's just kind of interesting to me. Anyway, you do have this pattern here, and I would pay attention to this Monday, and I would look at other semiconductor names and other names that are going to speak at CES. You can Google it yourself. It's in Vegas from the 6th to the 10th. We're off on the 9th because of Carter and the funeral and the holiday. So why is that important? I'll tell you why I think it's important, because CES is still going to go on. So the 10th is probably going to be a little more volatile, or the end of the week will be a little more volatile than people think. Now, if you take a look at this and then you look over like on the weekly, it looks like a completely different chart all of a sudden. You would actually look at this and go, geez, I wonder why I ever doubted this thing, right? Because here's your break, here's your flip over, and now you have this really strong close. And again, I just want to point out and be Captain Obvious. This is the second weekly highest close that you've ever had on the name. And you haven't even gone through earnings yet. And the year's just beginning. So there are really good signs here. But this to me was really what I found somewhat troubling. We're running up, and we're running up from 10 o'clock on, which is really just retail, right? And so the majority of this move happened in the beginning of the day, and then we just sat there. So did we really go anywhere after the first half hour? No. And that's just, we have to understand what it is, because we walked through this extensively in today's video. This is retail usually. I'm not saying institutions don't buy, but that's what you're dealing with here. And then you just kind of sideways. So I'd just be a little concerned with it. You're going to want to watch the follow through. I don't know that Monday is going to be the issue. Perhaps Tuesday morning may be the issue if he doesn't really pull some kind of rabbit out of his hat. Now we could all say that we pinned here because of the 145 strike. Maybe that's the case. And it did trade up a little bit after hours. But we're going to want to watch this 146 and see the follow through, and then understand that we have the CES risk. Now, two other names I want to go over. And Tesla I do want to address, because all you did was straight up. So whenever you have these 45-degree angles, you have to understand that really what you're seeing is institutional sponsorship. Anytime you have like a 45-degree angle where it's like that obvious that you're just doing that. I mean, you can literally go here and drop the line and then come across, drop another line, and just, put your X and Y axis there and just look at it. I mean, it's not crazy to see from here over. Let's just drop that there and we'll get to it. Let's see what I'm talking about. So, I mean, when you start to see that, right, and then you can actually even take this off just to make it even more absolutely glaring at how obvious that is, that you're just literally on a 45-degree angle. Someone's going to take a protractor to it. Tell me I'm off. But you get where I'm going with it. When you see this kind of stuff, you want to pay attention to it. This is systematic buying, but also it might be that you just had shorts trapped and that all day they're just trying to get out of it and they could never, ever get a break. Like there was really no lower low here. You had one off the open, right? And you have the first half hour where we have retail, and then just watch that last hour on. And this is exactly why I want you to understand that last hour of trading, why I'm spending so much time on it, talking about it over and over and showing it in application. Because when you see it and you're like, oh, 3 o'clock, they drop it. Why? Liquidity grab. They come down here, they grab liquidity for who? Institutions. How long did that last? Okay, always look for these liquidity grabs in the last hour of the day. So, and then what happened? Then we just rocked and rolled into the end of the day, and then you were up even more after hours. Does this continue? Is it tied in with that EV market and what's going to happen there with the Cybertruck? Because the Cybertruck's now going to get that tax break. I'm not so sure on that. I think the jury's out here. I think you might get another short squeeze up. But technically speaking, you've got a lot of damage up here now that you're going to have to get through. I do think you have shorts trapped because you closed. Everyone that was short was giddy. Nobody was going to be positive on this name, and then you reversed and squeezed. People are going to say it's because of the $7,500 credit for the Cybertruck. It is what it is, guys. I think you have to be careful of that. I'll show you another one. And structurally, this did more than anything else out there, and I think that's really important to get. Structurally, we flipped, and MSTR, when it did this, you got over some key levels here. So you got over the 55. You closed over it. You closed over it on pretty huge volume for this on a Friday. Does this continue? Is he going to do a secondary or another private placement? I think there was some rumors of that at the end of the day, or maybe there's a news wire on it. It doesn't really matter because people are going to buy it or they're not going to buy it. I think what's critical here is that you now are back over and you have institutional support. So if you were looking to buy this is a pretty interesting spot to take a look at it. You have to be willing to go for the ride. You have to be willing to look at these 20, 30, 40 point swings like they're nothing. And I do think that you are finding some support here. If you drop your level right in here, the undercut from that comes down, fills the gap essentially, and then lifts. That's pretty textbook behavior. And I don't think you have to look at this from the standpoint of, oh, I've got to hold this forever. But when you see this kind of behavior, you want to pay attention. And I'm a pretty much top-down guy, meaning If I look at the underlying asset, like Bitcoin, for example, and it doesn't matter which one we use, and I see that Bitcoin, since the beginning of the year, that asset class is going higher. So the asset class is going higher, and we could look at that and take block as the sector and realize that the sector in and of itself is now popping back over that 55 as well. Well, this then becomes a place of interest, right? Because someone that's top down, and by top down, I mean the way that I view things is I look at the index. Whoops, let's get rid of that. I look at the index, and then after the index, I'm going to look at the sector. And then after I look at the sector, then I'm going to look at the stock. So that's really what it means by top down versus bottom up, who just cares about the underlying asset or the underlying stock. So that when I look at Bitcoin, which is in this case would be the index, and then the sector, which is block, and then you look at MSTR, I'm pretty aligned here. So the chances of this holding, see, when all these are aligned, the probability of that trade working is greater. Right? It doesn't mean it's going to work. It's just greater. It just is what it is, right? If you were just to look at the moving averages and take this all off for a second, you can see how this played out. You have the cross still here. So it's not like you're out of the woods, but it's starting. And when that starts, it's something to pay attention to. Now, one thing that you have to pay attention to when I say I'm top down is I want to go where the money's going. If you go and take a look at what's happening in Argentina, and I've been talking about Argentina since he got into power, they no longer have a deficit. Go look at how many countries out there don't have a deficit right now. And the only thing that you could do with Argentina is go and take a look at what happened when Clinton no longer had a deficit in the US. That's the most recent example that you could look at. Now, some people are talking about Greece, and I haven't done enough work on that yet, but I'm going to do work on it since it was brought up to me. If I look at Argentina and I look at how this is playing out, and I go and take a look at the banks and how those banks are moving on this news, this is not over. You have to understand how this stuff plays out, and I don't think a lot of people do. You're not even back to the levels on where all the carnage happened yet. And again, we've been in these for some time and done very well with them, but I'm not so sure that this is over, not by a long shot. And I think as long as he's in power, you're going to see more stuff like this happen in Latin America, where other Latin American countries are going to go, why aren't we doing this? And then that's going to tie you into the consumer, right? And then you might look at something like Meli and understand that they have a huge Latin American presence. Therefore, something like this might be pretty interesting to start watching. See, all this stuff's tied together. And again, you want to watch the financial names in Argentina, but does this spread? Do we start seeing more and more people start changing the way that things are done down there? And that could be a boom. No one's going to want to watch someone else's country that's right next to them boom off a different way that politics are, and then not try to have something like that happen in their own country. So I do think that this is something to keep our eye on. That's it.